Welcome, New York, to Deconstruct Live. If you don't know, we run, host, produce the Real Deals podcast. It's called Deconstruct. I'm Isabella Farr.
And I'm Suzannah Cavanaugh. We're very excited for this conversation. We are doing a roundtable style discussion with 3 lenders. We're hoping it'll be a super candid conversation about what's happening right now in the lending markets.
As I'm sure we all know, we're nearing this inflection point for commercial real estate credit markets. 2024 rate cuts are looking less likely, and Class B and C multifamily have really joined office as pain points for borrowers with maturing loans.
Right, we're seeing foreclosures, regional banks are quivering. So how are lenders wading through the muck?
And that's what we're here to find out today. Let's welcome to the stage our guests.
Come on up. Okay, in right to left order for our audience, we have Seth Weissman, founder and president of Urban Standard Capital. We have Stuart, managing director of Fortress, and Mike Comparato, head of CRE for Benefit Street Partners.
So let's just get into the thick of it. I want to get straight to it. We are seeing distress across commercial real estate. Some of it's office, some of it's multifamily, but a lot of it is being triggered by a borrower's need to refinance, and we're in a much more expensive environment to do that. How are you all working with borrowers right now to work out troubled loans? Whoever wants to start, but Mike, maybe we can start with you.
Sure. Thanks for having us. And I think, it's been such a drastic hike in rates that it really starts with the borrower. They need to make a decision first, right? The decision is, do we want to contribute capital, extend our loan, hopefully live to greener pastures, brighter days in 2-3 years? Or do they, want to walk away? It's kind of that binary in the market right now for anyone who, bought something in 2021, 2022 and has a maturing loan. So, we're really being reactive to borrowers. If they want to work with us, great. Some are just calling us and saying, where do I mail the keys? And we're taking them back. So I think it's more the borrower dictates today what the starting point is. And then as long as there's any modicum of rationale in their proposal, we're trying to work with them. But where we struggle is when they say, we want these 10 things and you get nothing. And that's where it breaks down relatively quickly.
And I would add to that, it's the borrower's decision, but it's their LPs. And what do their LPs want to do? Because not everybody is ready, willing, or able to write another equity check to protect their position. And they're making the determination, does this thing have legs for a year or 2 years or 3 years whenever rates start to come down? So we're looking, for that guidance from the borrower and their LPs. And tied to that, we're looking for a commitment from them, and it might be some cash in at refi or some type of other restructuring milestones forbearance that demonstrate to us that they're willing to sort of put their money literally where their mouth is.
Yeah, look, I don't have a lot to add to what these guys said, but we look at the world the same way. If a borrower's having trouble, we're happy to work with them if they're happy to work with us. And whether that's, bringing capital to the table or, doing something constructive, we'd rather work something out and, hopefully get paid off at par. But if they're not willing to work with us, we're going to take over the property and, go on to the next.
Right. Seth, I'm going to throw this one to you. You do a lot of bridge loans, so looking at floating rate, people with that sort of debt, a lot of them are looking for extensions. Specifically, if they want more time, what do you want them to come to the table with?
So we typically have extension options baked into the loans, right? So our average bridge loan is 18 months in duration. There's typically 1 or 2, 3 to 6 month options that lay out the terms of those extensions, and it's largely driven by replenishing interest reserves or any underfunding of carry. So we're looking for them to abide by that, or at least make the case, why they're looking for some type of modification or adjustment. But the underlying base documents govern that. For us, we're very much a relationship programmatic lender. About 75% of our clients are repeat borrowers or direct referrals. So the spirit of that is that we're the senior lender, but we're a partner, and we want to help them get to the finish line. I feel like half my day is spent being a therapist because it's a tough environment, and it's been a tough environment for a couple of years, and probably will continue for the next 12 to 18 months. But it's a conversation. But again, to my earlier point, we're looking for some substantive, equity commitment if they're looking for any kind of relief or additional extension.
Got it. What you said, so you said we're their lender, we're their partner, right? I want to, this is a little contentious, but Mike, when we were talking on Monday, I think you said, we're your lender, but we're not necessarily your partner. How do you distinguish that from what Seth said?
Yeah. When things go bad, borrowers call and say, you're my partner. And we have to remind them nicely, we're not your partner, we're your lender. We will help if we can help. But again, if you show up to the negotiation or conversation and say, we want these 10 things, and we have nothing to bring to the table, literally nothing, no cash, no recourse, no new covenants, no new structure, no new nothing, the conversation just breaks down very, very quickly. We acknowledge it's a really difficult time. We don't want to be in this position either, but it takes two to tango.
So you both mentioned, all three of you mentioned how borrowers need to come to the table with more capital, and a lot of that is to buy rate caps to hedge against rising rates or just for general CapEx spending. Seth, your firm launched a $100 million fund last year to spend on gap financing, so senior stretch, mezzanine, preferred equity. What products did you see the most demand for, and where did you actually deploy that cash?
So we've seen tremendous demand for those infill, slices of the capital stack. Anybody who has a maturity this year, first or the majority of 2023 and going into probably next year, has a shortfall in what the senior lender will do. So they're looking for either preferred equity or mezzanine financing, which we will provide. We need an intercreditor or recognition agreement with the senior lender. But we've also just been doing a lot of stretch senior loans. So doing loans of proceeds that a bank wouldn't underwrite to because the debt service coverage isn't there. And that's choosing, what we've seen is that's become a much more preferable option for a lot of borrowers, because when you do the, permanent financing with mezz or pref, typically that new senior loan has a minimum term attached to it with significant defeasance or prepayment penalties. And so if you think rates are going to come down, you may not want to sign up for that 5-year loan term and say, I'd actually rather just pay Urban Standard an extra 200 basis points to kick the can down the road for 12 to 18 months. So we've seen this stretch senior product become much more popular than necessarily these plug prep pieces. But sometimes you present both options, and then you get to that point.
How about you two, Steve, Mike? What kind of lending products are you seeing demand for right now?
Yeah, so we're seeing a lot of demand for, what I'll call, gap equity or preferred, borrowers that, they probably bought something, 2000 or 2020, 2021. They're on a floating rate loan. It's now come due. It's a great asset. It could be a, 100% occupied multifamily, but, it's just they can't support the new loan rate. I mean, at the end of 2021, LIBOR was 11 basis points. Now you've got SOFR at, 535 or whatever it is. So, the cash flow of the property can't support refinancing those proceeds. So unless they have deep pockets and they can pay the loan down, they're going to need to bring someone in, like us, and pay a high rate for preferred, which will allow them to get a refi done. Maybe gives them 2 more years. And at the end of those 2 years, if rates haven't come down, we're probably going to own the property at that time.
Yeah, I would just add, the biggest vehicle that we run is a publicly traded mortgage REIT, and we had earnings last week. I said on that earnings call, what's working? Everything. There's demand for everything right now. So we did CMBS, we're doing construction lending, bridge lending, mezz lending. We closed $1 billion in the first quarter, and it was very evenly spread amongst like 4 or 5 different products. So CMBS is relevant again. It's probably the lowest cost of capital outside of insurance money today. So it became relevant again. People still need to bridge to different bridges there. Construction is there. It's pretty active across the board.
So with a lot of this financing, there's a path to ownership here. And I know all 3 of you are comfortable owning these assets if a borrower does default and it ends up in that scenario. Mike, Benefit Street, for example, just took over a San Antonio multifamily property after the borrower defaulted on a $45 million variable rate loan. When you do take over these assets, what drives you to make that decision? And can you talk about whether a borrower's track record plays a factor in that?
Yeah, track record, of course, plays a factor. We are not a loan-to-own shop by any means, but sometimes you're a loan because there's no other choice, or own because there's no other choice. The San Antonio deal was interesting. It was on our balance sheet for 7 days. We sold it for $1 million profit, roughly. So the amount of liquidity in the multifamily space right now is tremendous. We don't want to take assets, right? We would like to work things out with borrowers, but sometimes there's just nothing to work out. And part of lending on real estate is occasionally owning it. So you better be comfortable owning it.
Yeah, I'd say we have the same approach. We make a loan, we're expecting to get paid back. We're not expecting to own the property. And, that is literally a last resort.
And for us, again, we're not a loan-to-own lender, and we're looking to, support programmatically as a senior secure partner, our borrowers. But it does happen. We're making the decision of whether we're going to take something back. We're looking at the underlying asset, and it may not work as a, equity business plan for the developer, but at our basis, it may make sense. And so, as a recent example, we had a client who had a project on the Lower East Side that was going to be a 2019 vintage spec boutique office. Turns out, not a great business plan today. And he gave us the keys back. We turned it back around and sold it to a neighbor at a profit. But that's off of our basis. It just would have never worked for him for the original business plan. And that's just a reality that, we went through.
Just to touch on that, it wouldn't work if you had, gone out and bought the asset outright. Is that what you're?
Yeah, I mean, it depends on how bullish on Lower East Side office you are, but we could have done that, but we also had the ability to just sell to a neighbor at a profit who wanted it for another use that was not an office. We could have made that bet, and sometimes we will do this, is we'll say, we'll put in additional money, we'll get this built, but now we actually are an equity partner, right? And so we need to get our money back, plus a return on that money, and we'll get the project to the finish line. Yeah. If it happened 1% of the time, that would be a lot. It doesn't happen that often, but I started the business as a developer and operator here in New York. Our lending program today is national, but I still have that ability, and our team has the ability to take over and monetize if need be, but we don't really want to do that. And we really, when we're talking to sponsors, we're looking for people who think like we think, which is downside-oriented, capital preservation focused. They built in their underwriting what happens when things go sideways, and they have a margin of safety. So we generally avoid these situations by not partnering with those folks in the first place. But it does happen. You have situations like with office where the underlying fundamentals effectively evaporated in a 24-month period. And that's, doesn't speak to that borrower. That just speaks to a bizarre moment in time.
So speaking of sponsor behavior, Steve, Fortress recently filed a UCC foreclosure on about a $500 million debt that is tied to a Charles Cohen portfolio. Cohen, in an affidavit, said you all came down on him pretty hard, but I'm wondering, what's your side of that?
Well, it's ongoing litigation, so I really can't say.
Maybe generalized comment on how, I don't know, however
I'll answer
you want
for
to
it.
couch it. Okay, great.
Pay your debt service, and it's not a problem. And pay the loan off at maturity, and he wouldn't be in the situation. Steve can't say it, I'll say it for him.
You want to leave it there, Steve?
I think he did a great job.
Okay. So I also wanted to ask how you all are capitalizing on the distress we're seeing. Steve, I know Fortress is buying some loans at a discount. So what do you like to see in those deals? What makes them attractive to you?
Yeah, so we're pretty active in the loan buying arena. We've probably bought a couple $1 billion worth of loans in the last 12 months. And, obviously with the Fed bringing, heat down on the banks to lower their commercial real estate exposure, I think we're going to see a lot more opportunities, and it's not all going to be brokered. Some of these banks, they don't want to air their dirty laundry, so they'll go out to, a handful of natural buyers. We've done a fair amount of what I'll call mark-to-market exercises for, certain institutions, and, maybe that stuff comes back around after they've put, more money into reserves so they can afford to sell it. But I think that's going to be a pretty big part of, the next 12 to 24 months.
I was at the Milken Institute's conference on Monday in LA, and I was talking to someone who said that there are actually less buyers out there right now for debt, troubled debt, than there were in 2008. And I was wondering if you agree with that and whether you saw that as an opportunity for firms like Fortress to come in.
Yeah, I don't know if there's less buyers out there. I mean, I talked to, friends at other kind of similar institutions, and I think everyone's, waiting for stuff to come out. And you saw the signature portfolios that traded. All the usual suspects were involved. So I think there's a lot of capital sitting on the sideline waiting for the opportunity.
And are you buying from regional banks? Because I know that there's obviously been a lot of regulatory pressure to get some of that exposure off of their books.
Yeah, I mean, it's going to be, I think, across the board. Maybe the regionals have more pressure because their CRE loans as a percentage of their total capital is probably higher. It is higher than the large money center banks, but it's going to be banks across the board, loosening up on their CRE concentration. And
I want to put, the buying distressed debt question to you too also. Are you looking at anything in particular? Is that a route you're going down right now?
Yeah, we don't really play in the buying debt market. We're taking advantage of the dislocation by just originating. So we're filling holes where the banks have left a massive hole in construction lending and bridge lending. It's interesting. You mentioned, Isabella, like the lack of buyers or fewer buyers than in 2008. And I think you really need, maybe the first time, to really split commercial real estate, because it's just different universes, right? Multifamily, I get 5 phone calls, emails, texts a day. I want to buy debt, I want to buy debt, I want to buy debt. Office, complete opposite end of the spectrum. It's toxic, it's apocalyptic, it's a pick a word you like. And then there's everything else in between. That's, the industrial, retail, hospitality. So we're just living in an incredibly bifurcated market in terms of asset class and where liquidity is for each of those individual asset classes.
Yeah, I would say that there's office and there's everything else. So I would agree with that.
And for us, we don't really play in the buying note business either. We do a little bit of it. For us, leaning in has been to step in where banks are not. I think if you look at our originations book, these are largely loans that would have been bank loans 12, 18 months ago. And we've sort of seen banks either completely be on the sidelines, they're dealing with asset management issues, they're dealing with very expensive deposits, so they're not lending. And the ones that are lending with significant depository requirements because they're struggling to keep deposits. If you're a consumer, you now can put your money in treasuries or money markets, and they're focused on it. And so they're moving that money. So the banks are saying, if you want a $50 million loan from us, we're looking for 20, 30% of the loan amount in a depository relationship. Well, I mean, most developers don't have that available. Developer balance sheets are notoriously liquidity light, and as a non-depository institution, that gives us an edge because we don't require that 20, even seen up to 30%. So we're leaning in and doing these what would have been bank-like loans, you know, a year and a half ago.
So looking at regional banks, you know, there's been a lot of focus on CRE exposure, obviously, just in New York specifically in the first quarter. New York Community Bank was in a scary situation. So looking ahead, do you expect those fears to be realized? Do you expect to see more bank failures like we had last year?
I mean, I expect that we're going to have more bank failures. I don't see rates coming down, you know, this year. So if you keep having rates up where they are right now, a lot of those financial institutions have negative equity on a mark-to-market basis. And, you know, once there's a run on the bank, you know, the FDIC's got to step in and take it over. So I think we're going to see more bank failures this year than we did last year.
Yeah, and I would agree. I mean, if you listen to Howard speak 2 hours ago, and Howard and I don't always see eye to eye, but on the banks, I agree. He said 500 to 1,000 bank failures. Absolutely. I think what he left out is there's probably going to be another 500 to 1,000 bank mergers where banks are going to have to shore up balance sheets by combining, cutting costs, cutting personnel. I really don't think the general populace appreciates how bad bank balance sheets are right now. I don't think most of the banks understand what's on their balance sheets. I don't think the banks understand how bad what's on their balance sheet is, and they're basically being told what to do by federal regulators, and that's equally as terrifying.
Do you think it's primarily an office problem, or do you think it extends into other asset classes? I mean, we, you know, rent stabilized in New York is its own beast, but also multifamily valuations have dropped.
I think it extends to multifamily, especially, you know, Class B and C assets. I mean, just the math inherently, if you were, you know, buying at a 4 cap and now at the 6 cap market, half the value has been evaporated, which is, you know, 100% or more of your equity. So the math, you know, ain't mathin', and it's a very difficult to overcome that. And I do agree that the banks have not had the sort of come to Jesus reality check that what these things, the underlying assets would have to sell for and where they would clear today. It's certainly true in office, but we've seen it in multifamily too. The rent-regulated stuff just adds an additional, you know, complexity.
Yeah, I would say it's definitely an interest rate problem as opposed to an office problem. I mean, you can't have the 10-year, you know, go up, you know, 300 basis points, and most banks' balance sheets have a lot of fixed rate assets on them. They're, you know, by and large not hedging that, and so, you know, the rates go up, prices go down. I mean, that's that mark to market, you know, negative equity is going to stress the system.
Yeah, I think it's an everything problem. It's not just a credit problem, right? I mean, the top 25 banks have incredibly diversified revenue streams. They have a bunch of different ways they make money. The community and regional banks don't. And not only do they have credit issues, they wrote a lot of 10-year fixed rate loans with 2 and 3 handles on it. That even if the credit's okay, even if they're performing, they are stuck losing money on those loans for the next decade. Well, I guess 8 years. But it's really, really bad, even the stuff that's working. I mean, it's how we ended up in the S&L crisis 40 years ago. Lend long, borrow short, rates went upside down, and the banks just literally don't know what to do.
So I know that there's a lot of capital swirling around distressed properties, but also just for attractively priced assets, situations where the owner is not necessarily distressed, but just wants it off their books and might be willing to take a cut on it. Would you be, on that note, specifically related to office, would any of you consider making loans to support an office acquisition right now, if the price was right?
I mean, sure. I mean, we've put out term sheets on office deals, and I agree with what Michael said. You know, we've seen demand for lending products across the board. I mean, with the pullback from the commercial banks, you know, it's lenders, you know, like the three of us up here who are, you know, putting money out and filling that void. But, you know, if there's a repricing of an asset, and first of all, we have to like the asset. I mean, it's got to be, you know, an asset that is long-term viable. There's a lot of obsolete office assets that should be torn down and something else should be put up. And so don't want to touch those at all. But if it's a good asset and someone's buying it at an attractive price and they need 65% leverage against it, yeah, we'll take a look.
Yeah, we just closed a loan on an office asset in Little Rock, Arkansas, and the group that we financed had bought the paper and foreclosed on the asset, and we were financing the distressed buyer. And the underlying fundamentals at the distressed buyer's basis, and certainly at ours, were very attractive in a stable submarket. So it's not a non-starter for us. We definitely charge for it because most lenders, it's like a zero bid for office, you know, with some exceptions. But we do look at it, yeah, very specifically.
Office is really bad. It's really, really bad. And we're seeing the trades, we're seeing it happen, and the market is kind of ignoring it. And I don't understand why we're ignoring how bad it is. You're seeing office assets in LA trade for less than $100 a foot. You're seeing office assets in Chicago trade for $50 a square foot. When you're the building across the street and you've got $150 square foot debt and the one across the street traded for $50, what do? Like, we're just pretending like this isn't happening. It's happening. The trades are happening. The foreclosures are happening. The REO sales, the bad loan sales are happening. And it's awful. It's I mean, values are down 70, 80%, and we're pretending like it's not happening. It's bizarre to me. How do you value an office building today? Well, actually, I asked the CEO of an office REIT, how do you value an office building today? Historically, there were two answers to that, or two words, NOI and cap rate. Those words were not used in valuing the office building. You don't know how to value an office building today. It's really, really complicated.
There's also something called land value.
No, and I think it's basis. And that's where, like, to Seth's point, I think he lent like $50 a foot in Little Rock, Arkansas. I don't know if that's good or not, but $50 a foot in LA is probably, you know, relatively brain dead. So I think a lot of this is basis lending. It's not cash flow lending. It's not debt service coverage or debt yield lending. You're just saying that asset used to be worth $300 a foot. It's trading for $90 a foot, and I'm lending 40. If I'm wrong, that's really painful.
No, I think that's exactly right. I mean, I think our borrower bought the asset for like $50 a foot. You know, we're at, you know, 25 or 30 or something like that. But, you know, to your point, like, those are unheard of numbers, you know, pre-COVID. And I think it really does depend on the location, the tenancy. You know, our building is at a Class A credit tenancy, but if you're a Class B or C mid-block building, you're toast. It's land value.
Okay, so to close out, we have to go to the Fed. We have another meeting next month. I'm not going to ask you whether you think rate cuts are coming and how many, because I feel like that question is overused at this point. But I am curious, you know, say we get 3 rate cuts this year. Is that going to be enough to help some of the distressed sponsors that you're seeing, or no, it's not going to cut it?
I don't think it changes anything. It gives hope, but a 5 1/4 Fed funds or a 4 3/4 Fed funds, it really, at the end of the day, doesn't change that much. I think what it will give people, borrowers, is hope that might have a 3 handle 6 or 12 months later. And so whereas 6 months ago, maybe they said we're going to walk away, now they say, maybe we'll put in more capital, maybe we're heading in the right direction, maybe the light at the end of the tunnel is a little bit bigger. But just mathematically, 50 basis points, so it's not a panacea by any means.
Yeah, I mean, it certainly would help, but I don't think you're going to see any rate cuts in the near term. That's my view.
And I would agree with that. It gives the borrower and their LP some hope and some argument to say we'll put some more money in. But I think you need to see some deeper cuts before people come back into the market, and especially we do stuff like on the for sale condo market. Getting a mortgage today, it's enormously expensive. I think that has to level out, come down into the fives before you see the market pick up, and it's 200 basis points wide of that today.
But the 10-year matters 100 times more than what the Fed does. Like the 10-year is really what's going to dictate long-term values and cap rates. And what we all need to accept is that our federal government is spending money like a drunken sailor. And the people say that's insulting the drunken sailor. But we're adding $1 trillion of federal debt every quarter. By the next election, not 24, but 28, we are going to have $50 trillion of federal debt. It's a real number. Like, it's just, things are going to get very interesting.
Well, thank you. I think we'll close out there, but really positively. But please, everyone, thank our guests. And thank you all.